250 stores.
Service provider model.
Red flag to me.
They've done extremely well. And a lot of landlords nowadays are just not offering any type of concessions when it comes to back or filling their spaces. So during COVID, when we first got into the pandemic, a lot of landlords were working with their tenants to be able to enable them to survive the initial onslaught of the pandemic, because as you all remember, we couldn't go into different enclosed areas and a lot of public places that people were just not going to because of all the uncertainty that was present. And so for a period of time there, retail as a whole definitely got hit pretty hard. But as of 2019, it's just made a phenomenal jump. The actual vacancies at U.S. shopping centers fell to 5.3% for the fourth quarter, which is the lowest that in this particular report Cushman & Wakefield ever saw since they began tracking in 2007. The asking rates for rent also rose 17% above 2019 levels. So again, it just kind of highlights some of the trends that you're seeing. Obviously, when it comes to certain types of retail, they talk about there are still some concessions being offered, particularly in centers that are run down or ones that just aren't up to snuff as far as some of the competition is concerned. But overall, it's been a bright spot in the commercial real estate business. And I've noticed it on my end. I do a lot of retail on my end. That's what I would say that I pretty much specialize in at this point. I probably do about 80% of my transactions in the retail space. And so, I can definitely attest to that myself. I don't know if you have any thoughts or comments on this.
Definitely seeing a lot of the same thing. I obviously believe that when it comes to these types of trends, I think it's also important to know your local market numbers, right? So it's like, this is national, right? When you're looking at some of these numbers, sometimes these articles aren't even national. Sometimes they're regional. Sometimes they're statewide. They're citywide. So it's like, just be very conscious of what you're reading and what, this is a national this is a national data set, which is obviously great news. And at the same time, check your hyper local market. I'm actually waiting on a callback on a retail center I'm trying to go into contract on right now. So if the owner's listening to this, please call me back and say yes to the date, right? What is there? Say yes to the dress. What is it? Whatever it's called.
Yes to the dress.
Say yes to the contract. That's what I'd like to say. Say yes to the LOI. I'd love to do some business. Excited it's a nice little retail center. But I'm a big fan of retail. I think that if you are not spending, like I'm still a fan of the big three, right? Industrial, retail, multifamily. This just goes to show you that I think retail is as strong as ever, because a lot of people have related. I think they've related retail to office, which I think is a silly thing to say. I think retail is a lot stronger of an asset class. Like I would probably not invest in office right now. Even I just met a guy who has a couple $100 million in assets under management, specifically in the medical office space. Obviously slightly different, but just overall, in my opinion, I think retail, industrial, multifamily are going strong, even in the crazy uncertainties of this current market. So anyways, I'm a big fan.
One of the things that they reference in this article too, which I know for those of you guys who are watching that are maybe not familiar with retail, a lot of times you can also orchestrate leases that offer percentage rent so that you can kind of share in the upside of, the revenues generated on site by the tenants. And so they reference that also being kind of an action on some landlords are taking to kind of just have an additional revenue stream that comes along with, the retailers just doing well on site. So they pay their
I actually like that model a lot.
I do too, because you share in the value, right? Because if you're setting, hopefully you set the retailers up for success by, beautifying the center, making it attractive. If it's obviously well located, it's a good location for these tenants to be able to operate. And if they're generating a sizable amount of revenue that supports their enterprise, it's only fair that you share in some of that as well. And if you have a really strong asset, you can generate some serious money in additional rent.
I think, in my opinion, when it comes to the percentage of revenue types of leases that you set up, I'm more of a fan when it comes to basically the Fortune 500 type of tenants. I would totally do a rev share on a Fortune 500 type of tenant, or a franchise type of tenant where they have proven track records. When you're dealing with an individual who maybe this is their first location, maybe second location, I don't think that it's something that I would just jump on doing. But I think that with the right type of tenant, I think it can be infinitely more lucrative than just doing a traditional gross rent or triple net lease.
You can always protect yourself in having like a break point where, you make your base rent payments. And then if for whatever reason they don't hit that price, then obviously they're still going to make their base rent payments. But if anything above that amount, they could pay. I think it's a great model to follow if you can implement it successfully in your investment. But all right. So next up is Walgreens sells distribution center in California's Inland Empire.
Your Rite Aids, your CVS's, and your Walgreens, they are not as strong of as, in my opinion, are not as strong of a tenant as a lot of people are giving them credit for. Right. So if you're looking for triple net deals, I think that staying away from a Walgreens, Rite Aid, or CVS is probably going to be a better option than looking at a 5 cap deal for one of these. I mean, this just goes to show that like they're trying to consolidate. They're trying to grab as much cash as they possibly can to keep the company going. Like if you read this last sentence, Walgreens said in June 2023 plans to close 450 stores, including 150 in the United States and 300 in the United Kingdom. Where it's like, think about it. It's like these are the types of businesses. Like you need to be conscious, like especially if you have these as tenants, like you need to be paying attention. And if you're a broker working with investors who are talking to you about triple net leases, stop sending them Walgreens, CVS's, Rite Aids. In my opinion, I actually don't think they're very, very strong at all. I would stick to you could be doing a lot of this is the type of research that you should be doing for them, and try to figure out what type of Class A or triple net lease tenants are doing an unbelievably good job. They're on the growth trends. In what areas are they on growth trends? Because sometimes it might even be more lucrative to buy a 4 cap, 4.5 cap, 5 cap on a much better tenant than it is to buy a 6.5 cap or something with a tenant that has the high probability of vacating.
No, and we've read previous articles the last couple of weeks where we've showcased that Walgreens is kind of recalibrating its entire business model, where it's trying to become more of a healthcare service provider, more so than just a retailer, and the amount of debt they've incurred as a company. And even the Moody's downgraded them to junk bond territory as far as their corporate debt is concerned. So you're right. I mean, there are definitely some cracks beginning to form for Walgreens. And I've been doing, I would say over the last 12 months, I've done 3 or 4 single tenant net lease deals. And so, I've been looking at mainly QSRs. I haven't done any Walgreens or anything like along any of those other lines, but a lot of the analysis that goes into these single tenant net lease is digging into the unit financials. So you look at the individual location to see how they're performing. Is their revenue like a good percentage between what they're paying in rent and what their revenue is? Is the rent to revenue ratio reasonable? You look at the guarantor financials and look at all the, if they have 28 locations and they're all doing well, then you look at the balance sheet of the guarantor to try to just further understand the investment opportunity. And then you can kind of get an understanding about whether or not the investment's worth whatever you're offering or making. And obviously, a lot of times you'll have to sign confidentiality and potentially even go under contract before they share that information. But that's the type of stuff you really need to look for. Just because it's a big name like a Walgreens doesn't mean that today it's worth the same that it was 2 years or 5 years or 10 years ago, because the business landscape could have very well changed. So
yeah, I mean that goes for any tenant, to be honest with you, right? Unless you know of anything else that you want to bring up here, but in my personal opinion, I mean, I think CVS, Rite Aid, Walgreens are probably the big 3 that are going through a massive transition valuations, at least for triple net leases. I don't know if you're familiar with any other ones that you'd really look out for, but I think those are the big 3, at least, that red flag to me.
Especially the ones that are commonly traded. I mean, because historically the pharmacy investment properties were some of the more attractive ones because of the retail component, because of the, they were offered a variety of services, but with the medical landscape constantly changing, and now they're deciding that to be more competitive going forward, they have to shift to more of a service provider model. It's just, it's going to be really tough, I think. But hopefully they can make it work. And maybe if you buy it today and you hold on to it for 10 years and they get in a better spot as far as a business is concerned, maybe then you can sell it for even more than what you bought it for. But you're obviously taking a risk there. All right. So next up is U.S. hotel construction reaches new records. As you guys maybe even see in your guys' local market, I know here in Louisville, we have a very huge deficit when it comes to hotel rooms for the market. And so we're seeing a lot of hotel construction across the metro area, really. And obviously this is kind of a growing trend, or a trend across the country. Apparently there were 5,964 projects in construction pipeline at the end of the year, expected to bring almost 700,000 new hotel rooms across the country. And so, they talk about the biggest proportion of those rooms, about roughly 62%, are going to be upper mid-scale or upscale hotels. And I think a big reason for that is obviously construction costs are very high, land costs are very high. So in order for the economics to really make it work, you can't really build a motel or a low-end hotel and make it function in most instances. And so that's probably why you're seeing that being the case. Plus in the metro areas where these construction projects are happening, obviously there's probably more demand for upscale, mid-scale hotel developments. So they talked a little bit about the pipeline and some of the cities that we're seeing the most development. Nashville and Phoenix were up there. Atlanta was. Dallas has the most, apparently, with 193 projects with over 22,000 hotel rooms underway. Showcases that, even past COVID, the hotel industry and hospitality in general has been performing very well. And I've had a chance to interview a couple of developers locally that operate in the hotel and hospitality space. All of them, in particular, when you talk about like boutique hotels, those have been operating. I mean, they provide that unique experience for people. They've done extremely well, at least. And I can comment on our local market. I can't comment on markets across the country, but I just thought I'd share that insight.
This is actually great news in a lot of different aspects, depending on how you read this, right? Because the way I see this is like, okay, well, the Nashville's, Phoenix, the Atlanta markets, Dallas, like they're very high for, like, they're big for conferences, right? Like they're big for business, like they're big for a lot of people traveling to those areas for not just vacations, obviously one piece of it, but also, when it comes to hotels, a big reason is, obviously travel. And a part of it's also for business and conferences that are going on there. So what I see is like, hey, in these local markets, finding the local, the hotels that are going up and saying, hey, the properties around those hotels, they're probably going to be going up in value, right? Like there's also going to be a lot of more influx of people coming to those local businesses, right? Those local types of properties. So I think it's important to keep in mind, like, hey, this is another one of those trends where if you follow the right trends and you're paying attention to your local market of like, hey, what's being built, what's coming up that's new in these areas, and what areas is that happening in, targeting the properties near it so that you can start prospecting for those people and say like, hey, we know as investors and investment sales brokers, hey, I know that X, Y, and Z is coming down the pipeline, which is going to bring a lot more influx, which means that the property across the street or the properties a couple blocks over are going to have a lot more people coming to them, a lot more influx of patrons or customers. That's a good thing for my buyers, my investors, to try to put some type of good product in there. So just, to keep it in mind, like, hey, where are those hotels going up? Which means there's going to be a lot more people there. Maybe you should be investing in or looking to invest in a couple of those key markets.
Yeah. And even on the land side, because we do a lot in the land space, but, if you have a decent swath of land and it's in a great targeted area where it's easy access to the interstate and there's a lot of different potential for uses, hotels can be a great anchor. We had a client of ours, we helped buy 4 acres of land, and we've had like a Comfort Inn and Suites, kind of a regional guy, approach us about an acre and a half of the land, and they're willing to pay a decent amount of money for this particular parcel, which would essentially eliminate his investment in the entire thing because, it would essentially recoup the money invested in this 4-acre lot. So he's considering it right now, but that's just one example. And then they build a multi-million-dollar development. And what does that mean for your piece of land next door that potentially could, you could then maybe build a retail center or maybe offload it to someone else to do some other form of development. So don't ever forget the land plays as well. Land can be pretty lucrative if you it's very nuanced, but it could be very lucrative as well.
Yeah, no, I love that you brought up that point, by the way. I think that's a great thing to look into, which is like, hey, if you see that there's a lot of there's a hotel going up here and you actually have a better parcel and maybe you're in contact with that type of person, I think that's a great opportunity for you to take full advantage of what that investment sale can do.
All right. So next up, kind of in conjunction with what we just talked about, Marriott signs record number of deals in 2023.
Yeah, I think this was actually a global. Los Angeles Marriott International has a record of 2023 in development, but I think it was globally. Yeah, global hotel signings resulted in 52% year-over-year or organic room growth. Yes. I mean, which is absolutely insanity. I mean, if you actually look at just read this one more time, the hotel brand company closed 2023 with net room growth of only 4.7%, according to whatever. But the global hotel signings resulted in 52% year-over-year organic room growth, which is obviously a record. It also signed a record number of organic management and franchisee agreements, averaging 2.5 deals a day and representing approximately 164,000 rooms globally. That's amazing. These types of organizations, I mean, it's incredible what they're doing. By the end of 2023, if you look down below, actually internationally, Marriott signed a record of 73,000 organic rooms across 74 countries and territories, including China, Vietnam, Japan, United Arab Emirates, and Mexico. By the end of 2020, just go up a little bit more. So it's like by the end of 2023, nearly 3,400 hotels with 573,000 rooms in the company's global development pipeline, a 15-year-over-year increase. Almost 8,800 hotels with more than 1.6 million rooms were in operation in nearly 140 countries and territories. More than 400 properties and nearly 64,000 rooms were added throughout the year. So, I mean, it's just amazing. I mean, to go off of your last article, we're kind of in tandem here, man. The hotel market, the hotel industry is booming. There's a lot of opportunity out in the world here. So if you have any clientele, I would also try to pick up a couple hotel buyers and try to find some good land parcels for them, or small time mom and pop run hotels that they can take over. There's obviously a lot of opportunity here. And this is obviously a global article talking globally, but obviously we just mentioned that nationally it's doing quite well.
Yeah, no, it's just the pent up demand, man. Like it's unbelievable how, I mean, obviously during COVID, it was likely outside of office and even office, I mean, it was probably the most affected industry in the commercial real estate industry. So
I agree.
They had this massive downturn, and then now you're starting to see this massive upswing. I couldn't agree more. I think there's a lot of opportunity, and internationally, I mean, that's something that I personally don't have a lot of experience with, but I'd love to at some point, because there's so much opportunity around the world for these different things. I know in the Middle East, there's a lot of opportunity with, a lot of these, they're kind of wanting to become like an entertainment type of district in a lot of these different countries. So I know there's a lot of investment being done there. Other parts of Europe, there's obviously tourism that's been a variety of different countries. So if you're of interest in doing something over there, there definitely is opportunity. So you're never going to have a lack of opportunity. It's more of just what can you make work by doing the research and putting.
That's why I like the multi-asset class philosophy, which is like, hey, like office might be down, but this is exploded, or industrial might be slumping with leasing, but because there's oversupply, but multifamily still on fire. So it's like really trying to ebb and flow throughout the asset classes, and figuring out what's blowing up.
All right. So next up is McDonald's new cosmic restaurant starts strong. So I don't know if you've heard of this particular concept. I had heard about it briefly, just in some of the publications that I follow as far as the quick service restaurant industry is concerned. But I did a little bit more research today, and I found this article. So they apparently rolled out this particular concept on December 7th, right near their headquarters in Illinois. I guess Bolingbrook, Illinois is where they're headquartered. And now they're planning to roll out 9 more in Texas by the end of this year. So the premise of the actual concept is that it's a really tiny footprint, and they're only offering, they're primarily offering drinks. So you have like these fruit blends, cherry boost, all these different kind of frou-frou drinks that you could see here, iced teas, lemonades, tropical spiceade. And then they also have some frappes and coffee options. So you'll have like a chai frappe burst, popping pear slush, and then the coffee-based drinks are like s'mores cold brew and turmeric spice latte. So I think the reason they've decided to go with this particular concept is they're trying to compete with a lot of these coffee brands that you see popping up a lot of places. So you have, at least in my local region, and maybe that's the same in yours, Henry, but we've got like Scooter's Coffee. There's a concept called 7 Brew that's primarily the same thing. It's like these 600 square foot prefab structures that they throw up pretty much on every corner, and they're just pretty much drive-through coffee shops. And those models can be quite lucrative. The margins on the coffee are phenomenal. It doesn't require a significant amount of people to be on site to be able to administer the coffee or whatever you're providing. And so again, your overhead costs are a lot lower. And so some of these models can be quite lucrative. And so they're even highlighting some of the technology that's present on site. Apparently everything is touchless almost, to where you order at the menu board, you can physically order, and then once your order is ready, they'll tell you what column to go to, and then you drive around and you could pick up your food or or the drink or whatever you have. And this can all be done electronically too. So they have electronic payment options or cashless payment options through your devices as well. So they're really trying to refine the concept with this particular location. And now that they've kind of refined it to a point where they feel comfortable, they're going to start rolling it out across the country. So don't be surprised if you don't see more of these popping up in your markets. Maybe not this year, but for sure in the coming years. And again, I
love this idea. I'm going to give a golf clap to McDonald's. I think this is a fantastic freaking idea. I think that this is actually a brilliant idea. And I'm actually excited to see how this starts to roll out nationally. This is actually quite interesting. I'm interested to also see what companies start to follow suit if this does incredibly well.
I'm sure it's going to do very well. I'm actually interested to try it out at some point. I mean, it seems like they're doing the 9 locations in Texas right now, but hopefully they make their way down here. And McDonald's is interesting because from what I understand, they pretty much own all their real estate. They're typically not a company that has like they'll have the franchisee, but typically the franchisee will lease from the corporate entity. So I don't know if there's an investment play there per se.
I guarantee you they're buying the real estate everywhere. And I mean, this is just a fantastic opportunity for McDonald's. Kudos to you, whoever's on the marketing side of things that came up with this idea. Bravo. I am a huge fan. I'm excited to. I'm not quite impressed with this decision. I'm excited to see how things pan out.
No, 100%. And obviously how competitors are going to respond, because now that McDonald's has done this, you better believe all these other companies are going to be looking
Wendy's,
and say,
Burger King, and the sort are all coming through.
Absolutely. Yeah. And even one of the growing trends too, which we can talk offline or whatever about, but there's a lot of these quick service restaurant concepts that are consolidating. So in Yum Brands, it's headquartered here in Louisville, they're consolidating like a Taco Bell and a Pizza Hut or KFC, and they're all putting it in like one building. And so you have like a small strip center that has like 2 or 3 concepts, and then those are getting traded on the triple net market or the single tenant net lease market. So yeah,
I like that idea.
Cool. All right. So another meh year for commercial property sales.
Yeah. So anyways, this is kind of like I alluded to before. Yeah, you can stop here. I mean, this is just kind of showing, it's fascinating to me because everyone kind of thinks that everything's, just going to be so good for a long time. I mean, this is quarterly transaction volume in the billions. And you can see in 2021 how things just absolutely exploded after COVID. And then you starting to have that lull in 2022, which was still fairly decent. And now in 2023, these are worse quarters in transactional volume than, I mean, it relates it back to nearly 07. I mean, this is worse than 2017. It literally just kind of relates it back to, like some of the quarters in 07. So it's just interesting to me. I mean, this is the lowest years we've seen of any quarters in the last almost decade. So I think it's just quite interesting. I mean, they're counting this as the last like 5 or 6 or 7 years. So quite interesting. This is why I think that's just important to pay attention to things like, I believe they completely overbuilt, especially like areas like Northern New Jersey is an incredibly hot market when it comes to industrial real estate. Very, very hot market. However, in the secondary and tertiary markets in New Jersey, where they built millions of square feet, I think they're out of their mind. Everyone wants to be as close as possible to Manhattan or all these major hubs. And then they built these huge industrial parks in the middle of nowhere, New Jersey, thinking that like the demand was there, and they're sitting vacant. There's millions of square feet vacant in random parts of New Jersey. And I just think it's absolutely like hilarious to look at, when in some other areas, there's such a crazy high demand. You can't keep, you can't keep stuff on the market. So it's like really knowing your hyper local markets, because you see articles like this, which kind of can skew your mindset sometimes, but it's okay. Hey, like, what's my local market look like? What like for the properties and leads and opportunities that I'm coming across, what does that look like? What's the price per square foot going for? Is there, what's the vacancy rates in my local market look like? And paying attention to that versus saying like, oh, well, industrial is not going in the right direction. Maybe your hyper local market is seeing better results than the national.
100%. And I think part of it too is that we have recency bias, where we think that the end of the world is here or whatever else, right? And I know a lot of agents and brokers out there that are struggling. I get it. I mean, it's part of being in an environment where transactions aren't happening as much. But even compare it to 2008, I mean, we're almost double the transaction volume what was occurring back in 2008. Comparatively, we're in a much better spot. And I think 2024 is already primed to be a really solid year. For those individuals out there who've been kind of doom and gloom and a woe is me, like, change that attitude, because this is going to be a unique opportunity for you guys to capitalize on. I think, again, this is again, we've had recency bias, because if you were in commercial real estate in 2021, especially in investment sales, like, you could shoot fish in a bucket. It was everyone was trading everything. It was at 3% interest rate. I mean, you could literally have made any deal work with those interest rates. I think at this point in time, it's just an opportunity for you to refine your skill set, become a more effective broker. And then as soon as the market turns, which it's already starting to turn, I'm already feeling it. We're very busy right now on our end on the investment side, which was not the same like it was 6 months ago. Again, just get ready, because it's going to be a good opportunity to be able to grow your business.
I feel the same way. Super optimistic about this year. We're already seeing the turn. So what's next for us?
A resource that I like to reference a lot. I may have shown this before or maybe not. I'm not sure, but NAR has a lot of these like reports that they like to issue for a variety of different things. They do have a commercial real estate market insights report that they release. It's somewhat sporadic, unfortunately. So sometimes they'll release one like in August, and then there won't be anything for like 2 or 3 months, and then they'll release one. So kind of take it with as it will. But some of these reports are very well thought out, and they're very obviously data dense. So it's kind of cool to be able to kind of pull ideas from. I use this a lot for my newsletter, and then other, if I see a unique trend or a unique insight that I think I want to share, I'll go ahead and extract this, and it becomes part of my content creation as well. So again, this particular report kind of gives a summary of, office properties in 23, multifamily properties. You can kind of see this trend. This is from data that they've followed over across, in CoStar data through NAR analysis. So, provides you with a little bit of a insight into, the absorption of different properties. And then further down here, they offer predictions. And in this particular, I don't remember the gentleman who writes this. I think it's their head economist is one of the people who are responsible, and plus with his team are responsible for delivering this particular report. So, again, it's just more of a resource. CRE Daily is another one that I know we've shown on this before. But, again, the more resources that you can leverage to get the most up-to-date information, the better.
Yeah, great insights, my friend. I mean, look, we just got access actually to Moody's here at EXP Commercial. I've been really diving into the analytics of it, and I think it's fantastic. It's just like another version of CoStar essentially, but I love reading these articles. I love going through these. I mean, what I'll do is that I'll pull specifically for New Jersey, all the submarkets and asset classes that I spend the most time in, and I'll just be reading and analyzing all these submarkets. And I really want to make sure that I have the best information possible so I can speak as intelligently as possible to my clients when I'm speaking to them. So I love this type of stuff.
Yeah,
a data junkie,
dude. Yeah, and not only that too. I mean, obviously with what we do on the content generation side, which I think I'm a big proponent that everyone should have some form of content creation on a digital platform. It's a great opportunity for you to showcase your expertise to a wider audience. I can't tell you how much business I've generated a decent amount of business just through me doing these videos and pushing them out to people and explaining about what's going on in the local market. I created publications that I share with different local business owners and stuff like that. And so it gives you an opportunity to kind of become that go-to expert. And for someone, if you're earlier in your career and you don't have the long-term connections that other established brokers have, this is a good way to be able to stand out. So again, I thought it'd be great to share different resources that people can leverage to learn and ultimately become better at what they're planning to do.
For the last article, actually, I know you're bringing up in a minute here for at least on my side, one more article in yours, which I think is interesting to point out because this is another one of those doom and gloom articles, which this could be the breaking point for commercial real estate distress. So look, there is no doubt that all of the properties that are going through debt issues, because what happens commonly is that when someone owns a property and all let's just say their tenants are vacating, because like the office space, as an example, you go from a place where your debt coverage ratio was no problem before COVID. And then all of a sudden, because of the vacancy, now your debt coverage is negative. And when you have a negative debt coverage and the valuations are coming down on that property because your income is now down and cap rates are rising, what happens is that there are covenants in the agreement with the bank on your loan that state that if your debt coverage ratio comes down to X percentage, or if the valuation of your property goes below X percentage, you will have to make up the delta, make up the difference. Where people are, there's going to be situations that are coming up over the next few years, 2024, 5, 6, 7, 8, 9, and 2030, like over the next number of years, where depending on how the interest rates are going and how the nuances of the commercial real estate industry are changing, there are going to be some people who are kind of stuck holding the bag and might have to come up with $1 million or more or millions of dollars to continue owning their property. So I think that it's just important to pay attention to, like, hey, there are going to be opportunities. They're right in front of you, and they're going to continue coming down the pipeline. And you just need to be prepared of how you can support those individuals going through those tough times. So keep it in mind. Be in a place where you understand how to support them, which is doing your research, having the buyers ready to go, being able to speak intelligently, and speaking with a number of their colleagues, professionals. Anyways, so I just think there was something else to point out that just be prepared, because there's an opportunity here. I don't think it's much as everyone thinks it is, but I think there's an opportunity here.
I think with banks too, they don't want to be in the business of owning real estate. So if they can work something out with the owner, they're going to try to do that. But there are going to be situations where it's untenable. They're going to have to do something about what the delta is. And so that in those cases, you'll start seeing repossessions of properties. And one thing that I'd love to try to get more of, and more on the business development side, is establishing strong relationships with banks. Because I did a deal relatively recently where I represented a lender for Walmart outlot. So the developer had purchased the Walmart outlot. He had defaulted, and then the bank was owning this property and needed to dispose of it. And I became their exclusive agent for the disposition of that property. And, if you're an agent that can build strong relationships with the right lending entities, you could probably get some deals that way. In this case,
right.
It was an out-of-state bank. They didn't know the area that well. I obviously advised them, and they were going to list it for half of what the actual value was because they didn't really know. The area had shifted a lot in the last 5 years since they had appraised the property. So they were able to get them a deal where it ended up being just right around what I had said the value was. And so they got double what they expected to get. So they were happy about the situation. Everyone left happy. If you become that trusted advisor and you know what you're doing, it's kind of built-in opportunities potentially.
Yeah, these small-time banks are going to be good people to connect with.
All right, TikTok. I'm still playing around with TikTok a little bit. I don't have the hang of it yet, but it's always fun to kind of play around with it. But TikTok accelerates real estate expansion, plans sizable leases in 3 cities. So this particular article, I know we had referenced a similar article to this earlier last year or mid last year, maybe it's fall last year, about TikTok trying to increase their footprint in the industrial space because of the TikTok marketplace where they start selling a lot of products via TikTok. So they've essentially are kind of becoming not necessarily like an Amazon, but they want to be able to fulfill those orders themselves through the distribution centers that they have. Now there's a bigger demand for office space. So TikTok, I guess, or ByteDance, which is the TikTok parent company, finalized or told their more than 7,000 U.S. employees that they wanted them to be in the office at least 3 days a week, and a decent contingent of the workers are going to be in 5 days a week. So they're looking to add roughly 100,000 square feet or more than that. I'm sorry, just 100,000 square feet in one of these newer developments. But they're looking to add several 100,000 square feet of office lease space in a variety of different cities, which include Nashville and Seattle, and I think LA was the other one as well. So again, it just goes to show that the office landscape is still evolving. And, if more companies like this, and this is a technology company, which you would think would be one of the least likely to come back to the office. So if we can see more of these tech companies kind of take a stand and say, look, we want you guys back in the office, then the office landscape could very well change in the next few years. So this is obviously good news. Go ahead.
There is so much interesting stuff here. I mean, just leave it the way it is for a second, because it says even at the bottom, everyone at ByteDance has a sublease agreement in the works to expand its footprint in San Jose, California. CoStar reported ByteDance subleases roughly 660,000 square feet from Roku and is looking to sublease additional space, potentially another 357,000 square feet from the streaming device producer. I mean, this is all in San Jose, California. I mean, it's just insanity. I mean, I can't believe how much actual space they're working on here. I mean, they're going to add 132,000 square feet, replacing the Microsoft space, regional footprint to more than 242,000 square feet regionally in the Seattle suburbs. They're looking at 50,000. Let's see here. In Nashville, they're going to add over 100,000 square feet there. I mean, God bless TikTok. I mean, this is what happens when an entire generation is just stuck to or glued to a device. So I mean, like huge opportunities here. Trying to. I guess, work with some of these landlords and try to see if we can, I would try to reach out to the real estate department and see where they're looking to go and try to find some good opportunities here. This could be crazy.
Yeah, no, 100%. And again, I think it just, part of this is the narrative. I mean, if we're able to kind of change the narrative of getting back into the office, and I think ByteDance has made a statement by putting forth their effort into trying to get into these top locations across the country, and other tech companies could potentially follow suit, because again, TikTok is kind of becoming the 800-pound gorilla in the social media space, especially for the younger demographic. And so in order to potentially compete, and maybe their performance improves because of them being in the office. And I'm a big proponent that for certain roles, I think being in the office is a great thing. I think not everyone can concentrate or do things properly at home. So, sometimes it requires you to be physically there. And in particular, if you're going to be collaborating with people, I really do like the idea of being able to be physically there with someone and kind of talk through things and be able to orchestrate what your plans are in a physical format versus digitally. Obviously, you can do it digitally. We're doing this digitally right now, but what it would be even better if you're physically kind of hanging out. And so,
yeah, I think there's a lot of people talking about how like a lot of companies went virtual and then they're like regretted it massively, right? Like for a period of time it worked and then everyone got lackadaisical and then all of a sudden it really set in to really show you that like, hey, like if you want productive people, you need to be in the office. Anyways, I think this is a good foresight for the future. I still don't know if office buildings for say are going to, really come back with a vengeance, but we'll see. We'll see. So anyways, that's really it for the show per se. We appreciate you guys so much for tuning in. Again, we come to you live each and every single Wednesday, 3 p.m. Eastern Standard Time to talk about all current events and commercial real estate. If you guys have any news articles or anything you'd want to get our 2 cents on, make sure you drop it in the comment section down below. We'll be sure to at least respond with our 2 cents, or even on the next episode, we'll bring it up. If you want to even email us some articles, we would love to at least be able to review that. You can send that to the deal at CREnewshour.com. We'll also check out the news articles and have that on the next episode. Besides that, guys, we appreciate you tuning in, and we'll see you guys next week. Take care, everybody.
See you guys.